Welcome back, everyone, to Invest the Rest. Today, we have a longer video, and I'm going to do a full account update that covers all three of the $10,000 funds or portfolios that were started at the beginning of 2025. So we're going to go over the growth portfolio, the dividend portfolio, and the options portfolio. If you've been following the market, you know last week was one of the worst weeks for the market overall in a very long time. And I think this video will kind of demonstrate what strategies do well during a down market, what strategies do horrible during a down market, and why a combination of strategies may be better than any strategy by itself. So I'm going to get right into it because it is a longer video. As always, this is not financial advice. I am not a financial advisor, and my videos are for entertainment purposes only. And again, if you're new to the channel, thanks for joining. Hopefully you find this content informational. This is an overview of 3 different accounts, all with different strategies that were started at the beginning of 2025. So the first account we have here on the screen, the growth account, right? We have Fidelity Blue Chip Growth. We got Fidelity Stocks for Inflation. We got Vanguard, John Hancock, Invesco. Some more Vanguard 500, Russell 1000. We got the S&P, iShares Consumer Discretionary. We have quite a variety of different funds in this portfolio. Very terrible market lately. As you can see, we're about 50-50 on what funds are in the red, what funds are in the green, right? Our biggest loser is FBCG, 3.63% in the red. And I think that's because this fund is a little bit more aggressive. If we look at the 2024 performance of FBCG, it was 47.7%, or the highest return of all the funds in this account. And to meet those high returns, they have to be more aggressive for what they invest in that ETF. So we bought at $44.94. $46.64. It's currently at $44.94. As you can see, because this is low, medium risk, a lot of these funds don't react super volatile towards a down or an up market, right? You get slower returns on a bull market. You also get a slower loss on a bear market. And that's kind of some of the attractiveness to this type of investing. I think this is an account more for the longer term, right? You're going to gain those gains on average slower, but if you keep it in there for many, many years, you won't take huge hits when the market does go through a downturn. Now, when the market spikes, you also won't take advantage of all the upside, but it's a very stable, a very low volatility type of investing. You can see overall, minus 0.4%, basically even. We are down $39.84 overall. Our front runner, FDLO, low volatility, Fidelity ETF, 3.98%. And really we have we do have a large variety. Some are down just under 0, some are just above 0% return. And you can see from this column here, a wide variety, but that variety is about equal on both sides of 0, right? We have the minus 3.63 and the positive 3.98. We have the minus 1.7, we have the positive 1.1, and so on and so forth. So that's why diversity to me is very important. That's why I try to create a lot of diversity as far as the stocks that I buy within any portfolio of any given strategy. So basically even, down $40 for the growth account thus far in 2025. And we're really at the end of this week, right? This video will post on Saturday. This is as of close of market on Friday of the last week in February. So we're 2 months in to our strategies, right? 2 months into 2025, and this is where the growth account sits. Now, if we go over to the dividend account, all right, let me zoom out. I did do an updated video on this earlier this week because we did have some dividend announcements. All of the dividends in February, if I scroll down here, have been paid or at least announced, right? The last ones were paid on Friday. And so, again, closing out that last week in February, we'll be headed into March with a new March chart down here, and we'll take a look at when each fund is going to announce their dividends for the third month of 2025. Now, again, this is a more volatile, a more risky type of investing. This really exposes you to all the downside in a bear market and capped upside in a bull market. But the capped upside is cash flow into your account, right? You get that money and they can't take it away from you. So as long as this account isn't liquidated when the market is in a slump, my idea is that if you were to get out of this account, sell off the shares of everything that is owned in this portfolio, you would want to do that when the market is at a high, or at least above where you bought at, right? This is an account strategy that I don't think you should put money in that you may need to liquidate quickly. I think the liquidation or the exit strategy of these funds is critical, and you need to time it well. Now, if you're not planning on liquidating and you just keep the money in there, I don't know how important the capital gain or capital loss really is. I do keep track of it just to give myself a sense of how much I am down if I did need to get my money out. But I think as I've seen how this portfolio has performed over the first 2 months of the year, I would want to time my exit on this account. Now, compared to the growth account, I think the growth account, you have far more opportunity to liquidate this account if you needed the money more often than you do the dividend account, right? There will be bad times to liquidate the growth account, but I think there's less bad times, okay? Because of the stability in the growth account. So going back to the dividend account, we are down. If we were to sell all of our funds and realize our capital loss, we would be down $1,762. Now, we're not down that money. We haven't realized those losses, okay? We have earned or been paid $1,074.49 in dividend payments. That money, when those dividends are paid, get deposited directly into my brokerage account, and that money is cash money that can be used for reinvestment. I did just get $540.66 throughout the month of February. That money has not been reinvested yet. That money will be reinvested at the beginning of next week, getting ready to create that snowball, that dividend snowball for the month of March. And that's a good thing about this account. Okay, yeah, we're down quite a bit, right? We're down, the growth account is down $40. The dividend account in capital gains is down $1,762, or right around $700 when counting the dividends that we got. So the growth account's down 40, the dividend account's down 700 net, gains or losses, right? Which does give us that minus 6.88% total return on our initial investment. However, because the dividends are paid how they're paid and in cash deposits to my brokerage account, it is a very good time to buy, right? Everything is on sale right now. I can lower my cost basis significantly by reinvesting February's dividends back into my portfolio, buying more shares of the funds that already exist in the portfolio and lowering my average cost. What that will do is that will next week significantly help the amount that I'm down in capital loss, or the hypothetical amount that I'm down in capital loss. Now, that's assuming that the market takes a turn next week and tries to get back up to the level it was a couple weeks ago. If it continues to decline, right, we want to slowly invest that $540 over the month to continue to lower our cost basis through dollar cost averaging. So not too bad performance. I'm not worried about this account right yet. I think if the market takes a turn and increases to the upside, you will see the performance we saw near the beginning of the year. All right, so down $40 on growth, down around $700 on dividends. Let's take a look at the options account. So if you watched my option video update from earlier this week, you would see that in week 7, last week, or the week before last week, since today is Saturday, we got assigned almost all of our put contracts, right? I own 300 shares of NVDX, all 2 at a $14 strike price, 1 contract at a $13 strike price. I own 200 shares of MSTU in this account, both at an $8.50 strike price. Those 200 shares will be added to the 200 shares that I previously owned from week 3 at an $11 strike and a $12 strike. And then I also own 100 shares of MSTY at a $26 strike price. Now, that's not bad, right? We went a long time. We went almost 6 weeks. If you look over here in column N, of not getting assigned any puts. We got assigned a little bit in January, a little bit week 1 and week 3. But for the most part, the market was good to us and everything expired worthless. So it's about time, based on the strategy of this account, that we would get assigned some of those put contracts. I have no problem buying those shares at the price that I sold the contract because I'll turn around and sell calls when the market changes course. Now, week 8, last week, I was able to open a call contract on the 200 shares of NVDX that I had bought at a $14 strike price. I opened a call, $14 strike price, right? Because I'm going to open a call at the same strike that I get assigned a put, and I got $140 of premium for that call contract. Now, fortunately or unfortunately, depending on how you look at it, NVDX by 228 did not get above $14. So the buyer of my contract had the right to buy my shares of NVDX at $14 per share, my 200 shares at $14 per share. Now, they are not going to execute that contract because they can buy it on the open market right now at $10.76. So that contract expired worthless. Now, normally expiring worthless is good. We collect the premium and no action is required. However, in this situation, if I scroll up to the top here, no more exposure, all contracts are closed, right? But we have $10,700 of assigned put contracts, which means basically this account has bought $10,700 worth of shares of MSCU, NVDX, MSTY, anything that we got assigned on. So we own those shares, okay? We were able to go above that $10,000 initial investment because of all the premium that we've earned in the first 5 weeks, right? The total account balance is $11,424, and $10,700 of that we have gotten assigned through put contracts. Now, again, normally expiring worthless would be good, and I would just sell another call the following week. However, because I am almost maxed out on the amount of money I have, I am very limited, if not entirely excluded, from selling any more put contracts. Normally, with a market decline like we've experienced over the past week, I would like to sell additional put contracts to continue to lower my average cost basis, right? And that would open up more doors, open up more opportunity to sell calls at a lower strike price in weeks to come. However, I'm kind of stuck right now at the current strike prices because I can't buy more puts. I don't have the money in the account to risk selling a put and then getting assigned, okay? Because I don't have the money in the account to buy those shares. So last week, because of that, the only call contract that I was able to open was the NVDX. That's because Monday NVDX spiked a little bit. The premiums to sell at a $14 strike made sense, and I did that. I sold it two call contracts, NVDX, for that $140. Now, MSTU and MSTY did not spike enough on Monday, or anytime last week for that matter, to make it worth the premium to sell call contracts at the strike prices of 850, 26, or the 11 and 12 from week 3. So those sat there. That's why I'm really hoping for a slight market correction. I don't need it to go through the roof, but a slight market correction in the upcoming week so I can get call contracts opened on NVDX, MSTU, and MSTY. If I'm able to get call contracts opened on all of the shares that I own in this account, next week, depending on where the prices are, we could pretty much almost hit our goals next week. It's definitely a possibility. You can see how much premium, $140, just from 2 call contracts on NVDX. And so depending on where I open those calls, I could meet my March goal all next week. Now that's if the market is nice, that's the market is favorable for the strike prices that I own these shares at, okay? So that's where this account sits, okay? It's kind of in a stalemate in that we're just gonna be targeting selling call contracts on the shares that we own, and we're gonna continue that strategy until they get called away, okay? So we're going from a model of selling puts primarily for the first, I'll say 5 or 6 weeks, in 2025, now we're shifting to primarily selling calls, which is part of the strategy in this account. So the total, right, because I wasn't able to open more call contracts last week, the total for February, $665.29, very respectable premium income. Almost, if we were able to open a couple more calls, we would have been closer to January. But February is a shorter month, and I do anticipate, because of the length and the number of trading days in March, to do a little bit better in March than I did in February. What is the nice thing about option strategies, right? What's the nice thing about this $10,000 account? Well, I've made $1,424 in premium, and that premium, like dividends, gets deposited directly into my account. Once that happens, it doesn't matter what the market does. That money is mine, right? And that's why the account balance has gone from $10,000 all the way up to $11,424. So we'll take a look at the summary of all 3 accounts in a second, but I do just want to take a look at this table over here real quick, right? $665.29. 6.18% ROI, just under that 6.5% goal. However, because January we did 7.59%, we have reached our starting balance for March just about $80 ahead of goal, right? I wanted to be at $11,342 at the beginning of March, and we're currently going to start March at $11,424. So far we're entering the 3rd month at or ahead of goal, and I'm very optimistic for the call contracts that we're going to be able to sell next week. Now, let's take a look at the summary, okay? This is all 3 accounts, the dividend account, the options account, and the growth account. We've discussed the totals, right? The growth account down 40, the dividend account down just about $700, but there's that option account. That options account is that $1,424, and because that money is deposited, it's really, keeping the other 2 accounts afloat, right? We're still in the green. I'm still $700 up versus where I started at the beginning of the year, and market conditions have been terrible. And so I think a combination maybe of all 3 of these accounts could be the best scenario in the future, right? Instead of isolating them in separate portfolios, leveraging the strategies all together to ride out any unfavorable market conditions. Now there's one caveat with that, and the one caveat is on the option account. For those of you that have been following along, you've probably noticed this. What I don't track in the options account is the hypothetical capital loss of the shares that I got assigned at a certain strike, right? I own 200 shares of MSTU at $8.50. It is currently priced right barely underneath $5. So there is a hypothetical capital loss there if I were to liquidate this account today. The reason I don't track capital loss on my options account, and I do on my dividend account, is because of the difference in trading activity. The dividend account, in my mind, is a buy and hold, right? I'm buying and I'm holding these funds and I'm watching the dividends roll in. The options account, yes, I own these shares, and yes, I've lost money on the capital loss side on many of these shares, but these shares, through selling call contracts every single week, will continue to make me money. And eventually, they'll get called away, right? So because of the buying and the selling, the constant buying and selling, getting assigned shares and having shares get called away under all these contracts, I don't track capital loss or capital gain in this account. And I also don't track it because I'm not interested in having any capital gain or any capital loss in this account. The strike or the average cost basis of any of the funds that I get assigned, that's where I'm going to sell my call contracts. I'm not going to try to sell call contracts higher or lower. I'm not going to try to get more money. I'm just going to sell them. I'm going to get assigned. I'm going to sell the contracts at the same price that I got assigned at. And so that's why I don't track capital loss, but I did want to mention it for you guys that have been following along since the beginning. Hypothetically, if I did have to liquidate all of my accounts tomorrow, I would probably have a net loss, right? Because I would have to sell shares in the options account that I've lost money on that is not tracked on the summary sheet. But I don't plan to do that. Again, I always profess invest the rest, right? Get as much money as you can, discretionary income, additional savings accounts into the market as soon as possible, because more time in the market equals more money. However, if you've noticed, I always mention additional money, additional savings, discretionary income. Don't gamble with money that you can't lose. Don't invest money that you can't lose, okay? And when I say can't lose, I mean pay your bills, buy groceries, pay your mortgage, right? Send your kids to school, whatever it is. Don't use that money to invest, because at the end of the day, I'm not a professional. There's very few professionals out there. And if you are with a professional, that's great. You're probably paying them a fee, and that's your choice. And maybe you can be a little bit more risky with them, but they're going to be more conservative with the strategies that they use. So it's a trade-off. I like to do it by myself, but I never, because I'm not an expert, I never risk money that I can't lose. And that gives me a little bit more flexibility in needing to liquidate any of these accounts at a moment's notice, because I have to pay a bill, right? Bills came in, I have to liquidate and pay a bill, market's down. I don't have the luxury of time. I can't wait for the market to come back up. And so I have to take that loss so I can pay my bills. That is not a scenario you want to get into. That is not a stress you want to be dealing with when investing in the stock market. So that's all three accounts, right? End of February, that's the update. If the market swings to the upside this week, I'll put out another video. We will be doing quite a bit better than what's shown on the screen here today. But I hope everyone found this informational, entertaining, educational. If you did, drop a comment down below. Let me know what you thought. Let me know what you'd like to see in future videos. Drop a like, subscribe to the channel so you know when new videos are going to come out. You get notified if you turn your notifications on. And like I said, I always respond to every comment on my channel, on all my videos. So let me know what you thought. And as always, everyone, thank you so much for watching. Thank you so much for the support, and I'll catch you on the next one.